Your money is lying to you. Not in an obvious way, not in a scammy, stolen wallet way, but quietly, gradually, while you're busy living your life. If you earned the same salary this year as last year, you didn't break even. You took a pay cut, and inflation is the reason. Most people think inflation is just prices going up. That's not wrong. It's just dangerously incomplete, because inflation isn't really about prices. It's about power. Who gets it first, who loses it last, and who never even realizes what happened. And right now, inflation matters more than almost any other economic force shaping your life. Not because it's dramatic, but because it's invisible. Let's rewind. Imagine it's 10 years ago. You walk into a grocery store with a $100 bill. You leave with a full cart. Meat, produce, snacks, maybe even something unnecessary. Today, that same $100 buys less, sometimes a lot less. Same store, same shelves, same as you. What changed? The easy answer is greedy companies, or supply chains, or bad politicians. Those are surface-level explanations. They describe where inflation shows up, not why it exists. So let's talk about what inflation actually is. At its core, inflation is simple. It's what happens when money loses purchasing power. Not when prices rise randomly, but when the amount of money grows faster than the amount of stuff. That's it. That's the engine. Picture an island with 100 people and 100 apples. Each apple costs $1. Total money, $100. Now imagine someone doubles the money supply. Same island, same people, same apples. But now there's $200 chasing 100 apples. Nothing magical happened. No one got richer in real terms, but prices have to adjust. Apples now cost $2. That's inflation. Not because apples became better, not because farmers got greedier, but because the measuring stick, money, changed length. This is the part most explanations skip. Inflation isn't random, it's mechanical. So how does this happen in the real world? Not with apples, with dollars. Modern money isn't backed by gold, it's backed by trust and by the authority of governments and central banks. When economies slow down, governments want spending to continue. They want businesses hiring. They want people borrowing, investing, and consuming. So central banks step in. They lower interest rates, they inject liquidity, they create new money digitally and push it into the system. This doesn't feel like printing money. There are no trucks, no presses, just numbers added to balance sheets. But the effect is the same. More money enters the economy before more goods do. And here's the uncomfortable part. That new money doesn't enter evenly. It goes somewhere first. Banks, financial markets, governments, large corporations. The people closest to the source get to spend the money before prices adjust. By the time it reaches wages, salaries, and savings accounts, prices have already moved. This is why inflation doesn't feel equal. Assets inflate first. Stocks, real estate, crypto, things owned by people who already have capital. Then consumer prices follow. Rent, food, energy, healthcare. Wages come last, if they come at all. This isn't a conspiracy, it's an incentive structure. If you're the one controlling money creation, inflation is useful. It reduces the real value of debt. It encourages spending over saving. It keeps the system moving, quietly. Now let's talk about the lie inflation tells. Inflation tells you that prices are the problem, but prices are the symptom. The real issue is that your money is worth less than it used to be, and no one sent you a notification. If inflation runs at 7% and your savings earn 1%, you didn't save, you lost 6% of purchasing power. You just lost it politely, spread over time, without a headline. This is why inflation is politically safer than taxes. Taxes are loud, inflation is subtle. A government raises taxes and people react immediately. A government inflates the currency and the cost is diffused. No single moment, no single villain, just gradual erosion. And here is the irony. Most people experience inflation as a failure of the system, but from the system's perspective, it's often working as intended. Inflation makes old debt cheaper, it encourages spending over saving, it discourages hoarding cash. In moderation, this can stabilize economies, But moderation is the key word, because inflation compounds. A 2% inflation rate doesn't sound scary until you realize it cuts purchasing power nearly in half over 35 years. That's not a crisis headline, that's math. And when inflation accelerates, when trust breaks, it stops being invisible. Then it's no longer a background force, it becomes a social one. People rush to spend before prices rise again. Businesses raise prices defensively. Workers demand higher wages. Costs chase wages. Wages chase costs. This is how inflation feeds on itself. And once expectations change, controlling inflation becomes painful. Interest rates rise, borrowing slows, recessions appear. Someone always pays the price. Usually the people who didn't benefit from the early phase. Now, here's where the public story and reality diverge. You'll hear inflation explained as a temporary shock, a supply issue, a war, a pandemic, a shipping problem. Those things can trigger inflation, but they don't sustain it. Sustained inflation requires one thing: more money growth than real economic growth. Always. And that's the part that makes inflation uncomfortable to talk about, because it forces a question no one wants to answer directly. If inflation keeps happening, who keeps choosing it? This isn't about blaming one institution or one policy. It's about understanding trade-offs. Stable money means slower stimulus, less flexibility, more visible pain during downturns. Inflationary money means smoother crises and rougher everyday life. You don't notice it all at once. You notice it when you realize your lifestyle feels tighter even though you're doing everything right. Same job, same effort, same discipline, different outcome. And this is where inflation quietly reshapes society. It rewards leverage over patience, speculation over saving, assets over labor. It changes behavior. People stop asking, "How do I earn?" They start asking, "How do I protect myself?" That's not optimism, that's defense. Over the long term, inflation isn't just an economic variable, it's a cultural one. It changes how people think about the future, about risk, about fairness. And once that trust erodes, it's hard to rebuild. So when someone says inflation is under control, what they usually mean is this: prices are rising slower than before. Not that money regained its value, not that losses were reversed, just that the bleeding slowed. Which brings us to the final thought. Inflation isn't loud. It doesn't knock on your door. It doesn't ask permission. It just changes the rules quietly, then waits to see who notices. So the real question isn't, what is inflation? It's this: in a system where money loses value by design, what does financial security even mean anymore?